So here we talked about the introduction to balance sheets, and then this gets into some of the issues and the assumptions that we need to make in our balance sheets. So what are assets worth? Assets on the balance sheet need to have an amount associated with them. So we list all the assets and we have to value them. And one of the big questions is, how are the assets valued? For example, you bought a tractor a few years ago for $100,000. You've used it and taken $100,000 worth of depreciation on your tax returns. You could sell the tractor for $60,000. So what amount do we include for the tractor on the balance sheet? How do we value it? That's the big question. So one of the options is to list it the book value or cost method. Book value is sometimes referred to this method, and it's also referred to cost-based balance sheets. And this is to value the assets at historical cost less accumulated depreciation. So in the case of that tractor, our historical cost was $100,000, our accumulated depreciation is $100,000, and so the book value is zero. The market value is you list it for what you can sell it for today. We can sell that tractor for $60,000 today, so the market value would be $60,000. And one of the things you want to think about is, what are the advantages and disadvantages of each option? And they do have advantages and disadvantages. Some of these include the historical cost or book value method is really more conservative, and that's what GAAP would normally use for financial statements. That also is very accurate to coordinate with the income statement and the other statements to get your adjustments and depreciation. However, market value is more realistic to say really what are those assets worth. And so a lot of times in agriculture we mostly find market value statements, but they don't correspond with the income statement for the depreciation and stuff. And so we will actually do the statements in both methods in this class so that you'll see how to do both of them. Valuing current assets. So the cost basis and the mark-based balance sheets are really about how we value those non-current assets that we've had for more than 1 year or plan on keeping for more than 1 year. Current assets are different. And Farm Financial Standards Council, for either the book value method or the market value method, values those current assets at a conservative estimate of the market value. So they're being valued at their market value. The potatoes that you have on hand at the end of the year would be valued at what the market value for those potatoes are. Your calves that you have on hand at the end of the year would be valued at what the market value for those calves are. Under GAAP, Generally Accepted Accounting Principles, current assets are valued at the lower of cost or market. This means cost unless the market value is really low. So if you've had something that's driven that market value way, way, way down, they're not going to value them at cost because cost is too high, but they value them at cost. So if we followed this, those potatoes on your balance sheet at the end of the year that you haven't sold yet, you'd have to figure out what is the cost you have into them and then value them on the balance sheet at that cost, or if the market value is lower, the market value. The same with the calves. This would be difficult in agriculture because we don't know really what it costs to produce the 1 calf or 1 bushel of grain. We've got a lot of different those costs into them. Another issue in agriculture is that there's ready markets for these products. If we want to sell our potatoes, our grain, our calves within less than a week, and a lot of times within less than a day, we can actually go down and sell those products. So because of that, to be more realistic and to make it easier, we're going to value those current assets at their market value. One thing to think about is, for some assets, there may not be a ready market, or there's less of a ready market. For example, hay. You can normally sell your hay within a short period of time, but there's not really an auction or a ready market for hay. And so because of that, we'd want to be more conservative on the market value of that asset and really go down on the low side. Deferred tax on current assets. So there's 2 types of deferred taxes. One is on current assets, that's going to be on all the balance sheets and the other one is on the non-current assets. Deferred tax on current assets is income. Well, let's just talk about what the issues are. The income tax is paid to the IRS based on what was sold and cash expenses for it during the year. So we pay income tax based upon cash receipts and cash expenses. But in agriculture, we recognize income for producing a crop that we've not sold yet, and hence you haven't paid any taxes on it yet because it only goes on the tax return after you get that cash for it. And so once we do sell it, we're going to owe that taxes and have to pay it as soon as we sell it. So if we counted the value of those assets on the balance sheet but not the tax that we would owe against them when we sell them, we'd really be overstating what our wealth is. So what we call it is a deferred tax on current assets. So we've deferred paying that tax until we actually sell the asset. So we didn't have to pay it for for example, 2011. We grow potatoes and we hold them over and we don't sell them until 2012. In 2011, we don't owe that taxes because we haven't sold them yet. So we've deferred paying that taxes until 2012 when we actually sell the potatoes. So we've incurred the tax, but we've deferred paying it until we sell the crop. This again happens on both a book value balance sheet and a market value balance sheet. The way that you would find this is you add up the value of all the current assets that would be considered income if you sold them. Then you add up all the current liabilities that would be deductible if you paid them. You find the difference, and that is your taxable income. You multiply the taxable income by the tax rate, and that is your deferred tax on current assets. And it is a current liability, even though you may or may not pay it within the next year. Because it relates to current assets and current liabilities, it's a current liability. Deferred tax on non-current assets. This is a contingent liability to account for the taxes that would be owed if the assets were sold for their market value. For example, that tractor that we were talking about earlier, it has a book value of 0 but a market value of $60,000. If we actually sold it for $60,000, we'd have $60,000 worth of gain on our income taxes and would owe taxes on that. So if we're using that market value for the assets and we sold them for that market value, we would owe income taxes on the amount we sold them for above the cost less the depreciation. We'd owe income taxes on that $60,000. If this tax liability is not included on a market value balance sheet, the liabilities are really understated because we're saying that whole $60,000 is wealth, but really it's not truly wealth because the difference between that and the taxes that we would owe is our wealth. So we've got to include that liability, and deferred tax on non-current assets would be a non-current liability because it relates to non-current assets. So the way that we would do it is we add up the market value of the non-current assets and we subtract their book value. So this would be the value on the cost-based balance sheet, or book value is the original cost less accumulated depreciation. Another term for this, and the reason why I use all these different terms is because you may hear them in real life, is basis or tax basis. And so the basis is the value of the asset on the book, or the book value. So that market value less the basis or less the book value is the gain on the assets. You multiply that total gain from all the non-current assets by the tax rate, and that's going to give you the tax that you would owe if those assets were sold at the market value. This is the deferred tax on non-current assets, and it is a non-current liability on the balance sheet.